Hi. In today's video, we will learn how to work out the step 2 in a fund flow statement, which is the adjusted P&L account. This is where you learn how to calculate or find out the funds from operations or funds lost in operations. So this is a step wherein we'll have to take into account 4 guidelines. As long as you remember these 4 guidelines and follow it, your adjusted P&L account is going to be flawless. The first guideline is where you look at the balance of P&L account. The second guideline, you check for any transfer to reserves. The third guideline is where you check if any assets are written off. And the last guideline, you check for your adjustments for any direct entries into this step or your working notes wherein any amount has been transferred to P&L account. So let's not waste any more time and start working out a problem using these 4 guidelines. If you notice, this is the format of adjusted P&L account that we will be following, wherein we start off with a net profit for the year, and to this profit, we add the non-cash and non-operating expenses and deduct non-operating incomes. The main reason why we do this is because we need to find out the funds purely from operating activities. Now, when a net profit is calculated, we normally consider both operating and non-operating items. So therefore, in order to find out profit or your income or funds from operations, if there were any non-operating expenses that were deducted earlier, these will be added back. And if there were any non-operating incomes that were added earlier, they will be removed. These are the 4 guidelines I was talking to you about. So let's look at a problem. By following these 4 guidelines, finish the step 2, adjusted P&L account. This is a problem that we will be discussing. Let's look at the adjustments. The first one, a piece of land has been sold in 2011 and the balance has been revalued. Profits on sale and revaluation is being transferred to capital reserve account. Now, normally any profit on sale and revaluation is transferred to the profit and loss account, but in this case, it is transferred to capital reserve account. We will also notice that there is no amount mentioned in the adjustment. Therefore, let's look at the capital and reserve account in the balance sheet. Here, in note number 2, under capital reserves, you will notice under reserves and surplus note, you will notice capital reserve has increased from 0 to 20,000. So therefore, this is the amount of transfer, or this is the amount that has been transferred to capital reserve as a result of profit on sale and revaluation. Let's move to our other adjustments. Depreciation on plant and machinery has been written off. So we'll have to prepare a plant and machinery account to find out how exactly this affects the account balances. No depreciation has been charged on land and building. So we will also prepare a land and building account to check what exactly happens over there. A piece of machinery was sold for 16,000. Written down value is 20,000. So here again, we will enter these information in a plant and machinery account to find out what exactly is either the loss on sale or profit on sale. No furniture has been sold during the year. Now, normally, if there is a decrease in the value of an asset, it could either mean depreciation or a sale. Now, in this question, they've specifically mentioned that there has been no sale, and hence, if there is any reduction, we'll take it as a depreciation. An interim dividend of 20,000 has been paid. Now, certain adjustments like these do not really require a working note. So you can save your time and remember that it appears in 2 places. One, as a non-operating expense under the adjusted P&L account, and 2, as an application in the last step, which is the fund flow statement. The last adjustment, rupees 3,000, has been received as dividend on trade investments. This again is a non-operating income. Therefore, it comes in the adjusted P&L account, and it is also a source of fund. So it appears in fund flow statement. So the last 2 entries or the last 2 adjustments don't really require a working note. So let's start off preparing the adjusted P&L account. This is the format that I showed you. So before we start off with the format, let's prepare the working notes for the adjustments given. The first adjustment was related to land and building. So let's prepare land and building account. Land and building is an asset. So the opening balance of this asset comes on the debit side. To balance brought down the opening balance. Look at the note here, note number 5. The first item under tangible assets is land and building. So the opening balance is 1,25,000. And the closing balance by balance carried down is 85,000. Next, the profit on sale and revaluation is transferred to capital reserve account. So normally, if there is a profit on sale of an asset, it appears as 2 P&L account on the debit side. But here, they've specifically mentioned that it is capital reserve to which it has been transferred. And hence, we write capital reserve account, and the amount is taken from the balance sheet, where capital reserve increased from 0 to 20,000. Then we check if there is any other adjustments in relation to land and building. They've only specified that there is no depreciation charged on land and building. Therefore, we can close this account. The total being 1,45,000. The difference, 1,45,000 minus 85,000, becomes the balancing figure transferred to by cash or bank, which indicates a sale. This becomes the balancing figure. Let's move on to the next adjustment. Depreciation on plant and machinery. So we'll have to prepare a plant and machinery account. In the plant and machinery account, first let's transfer the balances. To balance brought down, go to your notes under tangible assets, you will find the opening and closing balance of machinery. Opening balance being 1,20,000. Closing balance by balance carried down. The closing balance is 2,25,000. Now, in the adjustments, they've mentioned depreciation. So therefore, it will be entered on the credit side as by P&L account, indicating depreciation. The amount of depreciation is 24,000. Now, apart from this, there has also been a piece of machinery sold for 16,000. The written down value is 20,000. Now, let's discuss this in further. What exactly is written down value? Written down value is basically the cost of an asset after you have deducted the depreciation. So over here, the written down value is 20,000. And this piece of machinery is sold for an amount of 16,000. So therefore, the remaining becomes loss on sale of machinery, 4,000. So therefore, this value, that is the sale and loss, is transferred into the trading account that we are preparing. The sale will be taken as by cash or bank, indicating sale amount 16,000, and the loss on sale will be taken as by P&L account, indicating loss on sale 4,000. With that, we have completed the plant and machinery account because there are no other adjustments in relation to this particular asset. The total comes up to 2,69,000. So the difference, 2,69,000 minus 1,20,000 will be the balancing figure, which is transferred to cash or bank account, indicating purchase. We go back to the adjustments. The remaining two adjustments are in relation to dividend paid and dividend received. Before that, they have mentioned no furniture has been sold. So let's just prepare the furniture account to see what exactly happens over here. Let's transfer the balances first. To balance brought down. The opening balance of furniture is 15,000 and the closing balance by balance carried down is 12,000. So here, when they've specifically told that no furniture has been sold, that means the reduction in the balance over here will be mainly because of depreciation. And hence, you mention by P&L account, indicating depreciation, the difference amount, which is 3,000. So with this, we've completed all the adjustments that they have mentioned. Now, apart from this, there was one point that I had discussed in the previous video where we prepared the schedule of changes in working capital, which is step 1 in fund flow statement. Over here, we mentioned in the last guideline saying provision for tax will not be taken in the step 1. It will be considered as a non-current item, and hence we'll prepare a working note for this and find out how much is the provision for tax and how much is the tax paid. Over here, they've given us under note number 4, provision for tax balance. So let's prepare this account. Provision for tax is a liability, and hence the opening balance will be on the credit side. By balance brought down. The opening balance is 62,000. And the closing balance, to balance carried down on the debit side, is 78,000. Now, normally in the question, they do provide us with either the amount of tax paid or the amount of provision made. In case tax paid or provision made is not mentioned, then we'll have to make an assumption over here. The assumption is that the opening balance, which is 62,000, will be the same amount, that is, the same amount of tax paid. So on the debit side, you will mention to cash or bank account, indicating tax paid as 62,000. And the closing balance, which is 78,000, will be considered as the amount of provision made as well. So on the credit side, by P&L account, indicating provision for tax, 78,000 will be mentioned. Now remember, this is mainly done to find out what is the amount of tax paid and what is the amount of provision made. If they mention the tax paid in the question, then on the debit side, you will write that amount. And automatically, the balancing figure will give you the provision made. On the other hand, if they mention the provision for tax in the adjustment, write that amount on the credit side. And then the balancing figure will give you the amount of tax paid. But in case of this problem where no information about tax paid and provision made are given, you consider the opening balance as the amount of tax paid and closing balance as the amount of provision made. So with these steps, we've completed preparing the working notes. Now let's start preparing the adjusted P&L account. Let's look at the guidelines one more time. The first guideline is where we look at the balance of P&L account. And that balance will be mentioned over here. In case the previous year's balance has increased in the current year, then it indicates a profit. If it has decreased, it indicates a loss. Let's look at the balance. Go to your question. Under the notes, you will find out more about reserves and surplus, wherein you will find out the balance of P&L account. In note number 2, you see P&L account. The opening balance is 26,000 and the closing balance is 35,000. Therefore, it is clear that the balance has increased in the current year, indicating profit for the year. So find out the difference between the closing balance and the opening balance. 35,000 minus 26,000. This amount will indicate profit, which is 9,000. To this amount, we add any non-operating expenses and non-cash expenses. Let's go back to our guidelines. The second guideline is we check for any transfer to any reserves, like general reserve or capital redemption reserve. In the question, under reserves and surplus, we have something called as general reserve, which has increased from 30,000 to 40,000. So this increase will be called as transfer to general reserve, which will appear as a non-operating expense. So we will mention transfer to general reserve, the difference amount, which is 10,000. Going back to our guidelines, the third guideline, we check if there are any assets that are written off, such as goodwill, patents, preliminary expenses, etc. So in our question, under the non-current assets, we have intangible assets, goodwill, which has decreased from 60,000 to 55,000. So this decrease will indicate goodwill written off. So in your adjusted P&L account under non-operating expenses, you'll have to mention goodwill written off and the difference amount, 5,000. Likewise, we also check if there are any other assets which are written off. We do have something called as preliminary expenses, which has reduced from 15,000 to 10,000. So this will also be a non-operating expense. So preliminary expenses written off, difference of 5,000 is mentioned over here. Moving back to our guidelines, the last guideline, we check our adjustments for any direct entries. That means we wouldn't have prepared any working note because we know exactly where these values appear. So in our adjustments, we have something called as interim dividend paid. We know that this is a non-operating expense. So in our adjusted P&L account, under non-operating expenses, we mention interim dividend paid, amount 20,000. Likewise, we also have an adjustment which says 3,000 has been received as dividend on trade investments. So this becomes a non-operating income. So dividend received, amount of 3,000 appears under non-operating income. So with that, we've looked into those adjustments which don't have a working note, which can be directly entered in our statement. Next, we look at the working notes and look for any value that has been transferred to P&L account. Over here, in the first working note, that is for land and building, we don't have any amount that is transferred towards P&L account. We'll move on to the next working note. Under plant and machinery, we have two items or two values that have been transferred to P&L account. One is towards depreciation and one is towards loss. Depreciation is a non-cash expense. So therefore, it will appear over here. Depreciation on machinery, amount 24,000. And also the loss on sale of machinery, which is a non-operating expense, amount of 4,000 gets transferred here. Moving on to the next working note. In furniture, we do have a depreciation, which is a non-cash expense, 3,000. Enter this as well. Depreciation on furniture amount is 3,000. Apart from that, there is one more working note where P&L account appears. This indicates provision for tax, which is a non-operating expense. Enter that as well. Provision for tax, 78,000. So with this, we've completed all the 4 guidelines that are required for adjusted P&L account. Now, all we have to do is solve this further. Let's add all the non-operating expenses to our net profit and find out how much is the total. The total comes up to 1,58,000. From this total, deduct the non-operating income, which will give us a total of 1,55,000, which indicates funds from operation. So here is a problem which we worked out using the 4 guidelines that are required to be looked into while preparing the adjusted P&L account. With this, you will be able to get your flawless adjusted P&L account. Thank you.